Hi everybody. In the last video, we concluded our discussion of the 5 events that can cause a change to the projected benefit obligation. In this video, we'll discuss plan assets. So far, our focus has been on the employer's obligation to provide retirement benefits in the future. We turn our attention now to the resources with which the company will satisfy that obligation, the pension plan assets. Like the PBO, the pension plan assets are not reported separately in the employer's balance sheet, but are netted together with the PBO to report either a net pension asset with a debit balance or a net pension liability with a credit balance. But remember that both the plan assets and the projected benefit obligation must be separately disclosed in the notes to the financial statements. The assets of the pension fund must be held by a trustee. A trustee accepts employer contributions, invests the contributions, accumulates the earnings on the investments, and pays benefits from the plan assets to retired employees or their beneficiaries. The trustee can be an individual, a bank, or a trust company. Plan assets are invested in stocks, bonds, and other income-producing assets. The accumulated balance of the annual employer contributions plus the return of the investments on the investments such as dividends, interest, market price appreciation, etc., must be sufficient to pay benefits as they come due. Illustration 17-10 in your textbook shows how plan assets change. This is an important illustration and should be flagged for future reference. When an employer estimates how much it must set aside each year to accumulate sufficient funds to pay retirement benefits as they come due, it is necessary to estimate the return those investments will produce. This is the expected return on plan assets. The higher the return, the less the employer must actually contribute. On the other hand, a relatively low return means the difference must be made up by higher employer contributions. In this illustration, we shift the focus of our numerical illustration to emphasize Global's pension plan assets. Let's say that plan assets at the beginning of 2021 were valued at $300 million. The expected rate of return on the investments of those assets was 9%, but the actual return in 2021 was 10%. Retirement benefits of $38 million were paid at the end of 2021 to retired employees. Using this information, we can determine that Global's 2021 ending balance for plan assets is $340 million. Let's work a concept check problem. Information regarding defined benefit plan of Corey Services included the following information for 2021. Plan assets at January 1st were $70 million. Plan assets at December 31st, 2021 were $105 million. Retiree benefits paid were $17 million, and employer contributions to the plan were $42 million. What was the actual return on plan assets for 2021? Please pause the video while you prepare your calculations and choose your answer. Then start the video again to check your work. The correct answer is A, $10 million. Use the formula provided in illustration 1710 to calculate the ending plan assets. Drop in the numbers you know and solve for what you don't know. The formula you were given is beginning balance plus actual contributions plus actual return plus employer contributions minus benefits paid to retirees equals the ending balance. We were given everything except the actual return. 70 plus what plus 42 minus 17 equals 105, and the answer is 10. So answer A, $10 million. Let's work another similar concept check problem. Information regarding the defined benefit pension plan of Corey Services, including the following for 2021. Plan assets at January 1st, $350 million. Plan assets at December 31st, $525 million. Retiree benefits paid, $85 million. Return on plan assets, $50 million. What were the employer contributions to the pension plan at the end of 2021? Please pause the video to prepare your calculations and select your answer. Then start the video again to check your work. And the correct answer is C, $210 million. This calculation, as you can see, is done in exactly the same way the prior problem was solved. A company's PBO is not reported separately among the liabilities on the balance sheet. Similarly, the plan assets a company sets aside to pay those benefits are not separately reported among the assets in the balance sheet. However, firms do report the net difference between those two amounts, referred to as the funded status of the plan. When the plan assets are greater than the projected benefit obligation, the plan would be overfunded and the net amount would be shown as an asset. However, when the plan assets are less than the projected benefit obligation, the plan would be underfunded and the net amount would be shown as a liability. From our previous discussion, and as shown in this illustration, we can see the funded status for Global at December 31st, 2021 and December 31st, 2020. Because the plan is underfunded in both years, Global reports a net pension liability of $110 million in its 21 balance sheet and $100 million in its 2020 balance sheet. It is important to note that the net pension liability is not an actual account balance. Instead, it is the PBO account balance and the plan asset account balance combined together and reported in the balance sheet as a single net amount. If the plan becomes overfunded in the future, Global will report a net pension asset instead. Again, a company must report a liability in its balance sheet for the underfunded status or an asset for the overfunded status of its post-retirement benefit plans. Well, that's all for this video. In the next video, we'll begin our discussion of the components of the periodic pension expense. See you next time.